Ladies and gentlemen, good day and welcome to the Mallcom India Limited's Q4 and FY2024 earnings conference call. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. And I've handed the conference over to Ms. Stuti Shah from Valorem Advisors. Thank you, and over to you, ma'am.
Thank you. Good morning, everyone. My name is Stuti Shah from Valorem Advisors. We represent investor relations for Mallcom India Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the fourth quarter and financial year 2024. Before we begin, let me mention a short cautionary statement. Some of these statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by the information currently available to the management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now, let me introduce you to the management team participating with us in today's earnings call and hand it over to them for opening remarks. We have with us Mr. Rohit Mal, General Manager, and Mr. Shyam Agarwal, CFO. Without any further delay, I request Mr. Rohit Mal to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Stuti. It is a pleasure to welcome you all to our earnings conference call for the fourth quarter and financial year ended 2024. Let me give you some of the operational highlights for the quarter and financial year ended 2024, after which our CFO, Mr. Shyam Agarwal, will brief you on the financials. The company achieved a branded sales percentage of 41% during FY24, up from 36% in FY23. This was because of rising demand of branded range of PPE in India, Middle East and Southeast Asia. This was also in accordance to the lackluster growth in Europe and some supply chain issues that we face for our private label market. As you may be aware, in the financial year 2024, the garment manufacturing unit at the city was fully shifted to and integrated with the newly set up garment unit in Chandipur, West Bengal. This new facility offers larger infrastructure, increased space and higher manufacturing capacity, leading to improved productivity. The temporary disruption in the raw material supply chain for the garment unit, as reported earlier, has been completely resolved, contributing to higher turnover and productivity during Q4 FY24. On the capex front, in the first quarter of FY25, the company commenced the second phase of expansion at Chandipur, West Bengal, setting up a new unit for manufacturing industrial safe tissue. This project involves a built-up floor area of 50,000 square feet with a capex of 20 crores INR. Commercialization is expected by the fourth quarter of FY25. The total capex outlay for FY24 was INR 26 crore, and the company plans to invest an additional INR 60 crores in FY25, funded through internal accruals. Additionally, the greenfield project at Sanand, Gujarat for Protec gloves and other PPE is progressing as scheduled, with the first phase of construction likely to be completed by July 2024. An investment of INR 38 crores has already been made, with an additional investment of INR 40 crores before the unit becomes fully operational. During the FY24, the company maintained a long-term rating of A with stable outlook assigned by ICRA. The company retained its status as 3-star export house and an ARO status holder awarded by the Ministry of Commerce and the Ministry of Finance respectively. Now, I will request Mr. Shyam Agarwal, our CFO, to brief you on the financial performance of the company.
Thank you, Rohit, and good morning to all the participants. I would like to provide an overview of our financial performance for the fourth quarter and the financial year ended 2024. In the fourth quarter, the company achieved its highest consolidated quarterly turnover of INR 122 crores resulting in a growth of almost 9% year-on-year. EBITDA for the quarter stood at around INR 17 crores with EBITDA margin at 13.48%. The net profit was reported at around INR 12 crores with PAT margin of 9.64%. For the financial year ending 2024, the company's operating revenue reached around INR 420 crores, indicating a latest growth of almost 3% year-on-year. EBITDA for the year stood at around INR 58 crores, which declined marginally by 1% with EBITDA margin of 13.72%. The net profit was reported at INR 36 crores with a PAT margin of 8.63%. Thank you. With this, to the questions and answers session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Zaki Nasar from Nasar Investment. Please go ahead.
Yes, can you hear? Hello?
Yes, we can hear you.
Sir, congratulations on a decent set of numbers in a kind of a muted international environment. As I see, India has performed pretty well compared to your international operations. Sir, I would like to understand the growth. What next for 2025-26? What kind of growth rate you are looking for? And also your mix between India and international, and also Mallcom brand and your white label things. And also a bit of margin profile with your new production facility coming up. Thank you, sir.
Thank you for the question. So in terms of growth, we are expecting something like a 15% growth from here for the next year, and we are geared up for that. In terms of India versus rest of the world, and branded versus white label. So branded is mostly in India, so I'm going to use it interchangeably. So the percentage split, we are looking at a similar percentage split as what we had this time. Also, maybe it could be a slightly increased percentage in white label because, the white label did not perform that well this year, so we are hoping to recover that. So I don't see much difference in the percentage split for 25-26. And I think the margin profiles we are expecting to have something similar as compared to this year, because a lot of the products which are going to be launched new are going to come only in the later half of the year.
Sure. And Rohit, if you are you noticing a better compliance from the Indian industry in terms of safety standards, sir, going forward? Or I think the government is tweaking labor rules and stuff like that, at least in terms of safety. So do you see that on a ground level?
Yes, definitely. That is happening. So the labor, regulations are getting stricter. And so from all ends, I think this is happening from the government and from the authorities and, let's say, the Bureau of Indian Standards, as well as the companies, some of the MNCs or the larger corporations in India, they would like to follow, a certain level of safety standard and comply to it. So I think it is happening, from both ends. Yes.
And a question for Shanvi, sir. What levels of debt would you be happy with, sir, till the year end and the next year, sir?
Talking of debt?
Yes.
Yes. See, basically, we are not borrowing anything, to meet our long-term capital requirements. So only working capital. So as you see, the level remains almost debt equity is 0.25 to 1. And see, already we are sitting with some cash, which is you can see it in our balance sheet. So I think it should remain similar because we are generating cash and we already have cash in our balance sheet. So nothing much is going to change. The only borrowing we'll have would be working capital borrowing.
Thank you so much, sir, and best wishes for Team Mallcom for 25.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Agam Shah, an individual investor. Please go ahead.
Thanks for the opportunity. A quick question on the CapEx you said, so broadly 38 crores we have spent, and including both the units, Sadanand and the Ghatampur, will be spending another 60 crores, right? In next year?
Yes. Yeah, that is correct. Yeah, 60 crore minimum we plan at CapEx for FY25, right?
FY25. So including this as well as 38 crores which you have spent this year, so approximately around, let's say, 100 crores. So when can we see the full benefits of all this coming in, and what kind of asset turns can we do on this CapEx? And when can we reach the optimum utilization levels which you foresee?
So let me just explain you how it is happening and why it is happening. So we have already stated our, the target till FY28, we target 1,000 crore CR. And for that, we needed to, prepare this infra ready and to, whatever demand comes in future and, so we can meet that demand and we should have infra ready, And this is the second point is that Mallcom is a 40-year-old company, and we needed to replace and consolidate also our facilities. So both things happening together. So CapEx which we have done recently last 2-3 years and is still going on is a major one, and now we see that it will take care of both the consolidation, replacement, and future growth requirement. And target for this is already stated. So we expect 50% minimum growth for next year, and let us see that we achieve this target of 1,000 crore by FY28.
So the number you stated by FY28, that will require at least 20% CAGR revenue growth. So the FY26-27 will cover for it, since we are targeting next year 15% growth. So is it like that? So once all the CapEx
target remains. We are not changing this, so we are definitely trying to meet that, and that's why we are investing, and all the investments and the CapEx happening is on track.
So the growth will be back-ended, right, towards the target. So FY26-27 will see a much larger growth, right?
This is what we target. Yeah, the plans are like that only. Yes.
Okay. And what can be the margins then when we reach, let's say, 800,000 crores by FY28? Then the margins
should be in the range only. So whatever, see, the product profile is not changing much, but yes, with the better technology and some upgrades as per market requirement, but product model has remained same. So margins should be in the range, at that range only. Whatever we are doing, a little bit variation, but not much expected.
So can it increase more than 15% or not? Remain in that range?
Definitely we will try, but as of now it is in the range of 14%, so it may be 50 basis point up or low. That is possible.
Okay. And there are some, I think, there are some land sale or which you are planning to do. So any updates on that?
Yeah, it is happening. It is in progress. So yes, we have already shifted our unit, garment unit, and the land is already in the process of development now.
Okay. But what kind of cash flow we can expect from that?
That we need to wait and see. So, we have you already know it depends upon the market. So we cannot, predict anything as of now.
Okay. That's it from my side. I'll join in the queue.
Thank you. The next question is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah, can you hear me?
Yes.
Hello? Yeah. So, sir, I just wanted to understand in terms of, like you rightly said, brand and India business are kind of synonymous, and non-branded and export are also synonymous. So, our growth of, say, 20-25% over next 3 years, or maybe that will take 4 years, doesn't matter whether you are at 1,000 crores at 28 or 29. But is it predicated on a similar growth in both branded and white goods? That's question number one. And my second question is, coming to the distribution of product, which is basically hand and feet versus body, is there a margin difference and a manufacturing versus outsource difference between, say, gloves and feet in shoes versus and headgear versus a garment or something? Are we manufacturing certain items in-house versus outsourcing, and what kind of margin difference is there?
Okay.
Hello.
Yeah. So, with regards to your first question, growth. So, till actually last year, we were predicting a lot higher growth in the branded, sales versus the white label. However, some, because of some of these geopolitical changes which are happening, and maybe a lot of big countries are going for elections. So waiting for that also, because that will decide a lot of things, how supply chain moves across the globe. So if that is favorable, so that can mean also decent growth from the white label also. So now we are hopeful for our white label business also experiencing a decent growth. It remains dependent on some of the macroeconomic factors and the geopolitical factors. So we'll have to just wait for that. But yeah, we are hopeful of this growth and much higher growth in branded sales as compared to white label. And with regards to the distribution of products and the margin difference, so usually all our margin profiles are dependent on whether it's branded or unbranded and what product category. So usually leather gloves is something which in at least the private label space does not command that much margin. Rest are overall on a similar margin profiles that you see on an overall level. And most of our products are in 90% or maybe more, 95%, we are manufacturing on our own. So we don't outsource, let's say, manufacturing, and even only the ones that we're doing are, some stitching pieces, things like that, which the factories cater to us only. But the final good is definitely coming out of our units for 95% of the cases. Only in case of our branded products, we are importing some items.
Good. Thanks. My understanding is that if you are going to say grow at 20% for next 5 years, you are saying that the branded India business will go higher than 20%, and the non-branded and internal business will go lower than 20%, on the assumption that the geopolitical situation across. Great, fantastic. Now, I just scanned around Pune, which is a large industrial area in Bangalore, and went to a couple of places which basically sell into this head and feet and protective this thing. Now, when it's the branding, what I saw is a bunch of cartons lying, and these stores are very industrial in nature, and there's no real branding per se, of any competitor here either. But essentially, the visibility of the product brand is a bunch of cartons lying in the front of the thing. And of course, our Mallcom's cartons looks much better than the competitor carton in terms of it's not sagged and it's not broken. But necessarily, what do you mean by branding in this kind of a business?
Right. Firstly, I would like to thank you for the question and the effort that you took to, be a real investor and check what is happening on the ground. So much appreciated. Just on the branding front, yes, absolutely correct that at our dealer's place, there's very little scope of brand visibility because of the space availability with them. We've tried to do something in the past, but it hasn't worked really well because, they would like to maximize the space with the stocking of the products than any other thing. So what we do essentially to build our brand is we reach out directly to the end user and try to create a pull from them. So for example, we regularly do technical symposiums or seminars in industrial belts where we call all the safety officers and purchase officers and explain them, more about safety, about new products that we are doing. And so that's something that we do. Other thing is we do some outdoor campaigns, where hoardings or brandings are in the outside place, but again, more in the industrial belts. We've recently done some, ads on, let's say, OTTs and theaters, mostly catering to tier 2, tier 3 cities because that's, again, where our audience is. We do a lot of digital branding and marketing, so from lead generation as well as branding on digital front. That's something that we are regularly doing, and again, participating in exhibition, different industries, different locations. We regularly participate there, and that's where we talk about our brand. So these are some of the various avenues, where we try to establish our brand.
Yeah, sure. In terms of hand and feet, those are like must essential. They're non-discretionary, quote unquote, for many of these industrial units. And obviously that reflects in our products also. They are more than 60-70% of our business. What about these other things like eye protection and body protection? Is there, so I think we are well placed in hand and feet, but what about the garments and eyes? And those so-called not essential, which may not be in many factories. If you go to India, they don't use eye gears or body gears, etc. So how is this industry specific? How you are trying to promote these 2-3 product lines?
Right. So with regards to workwear, it's very, again, a very highly competitive segment in India per se, because there's no such standard which has to be followed. So, any tailor who can get hold of the fabric is essentially our competitor. And in these cases, because there are a lot of sizes and customization, so people tend to near shore all these suppliers so that that they get faster supplies. So here we are trying to focus on quality. We are trying to focus on larger brands where and let's say international brands where they have a certain specification, where they would like to meet certain criteria or standards, and that's where we would like to target our energies to. So we are not trying to compete with anybody and everybody in this segment. We are trying to do specialized work only. But definitely we have to put in more effort into that domain, and we have started doing that with, recently launched our high visibility vests for the market, some specialized coveralls, flame retardant, etc. So that's what we are doing on the workwear end. And on the eyewear and things like that, yes, that is also something that we are currently trading only. But in the future, we plan to manufacture those items as well, and it's again like it's a more volume, less value item, and not something which is used everywhere, or people don't feel the need to use it. And again, draws back to some standards being followed, MNCs coming in, and the government making it mandatory. So that should help elevate the market. But we are gearing ourselves. So in the next 2-3 years, we'll definitely see some movement in that segment as well for ourselves.
Great. Can I ask one last question, or I can come back?
Sorry to request you to come for a follow-up question.
Please put me in the queue, please. Yeah, thank you.
Yeah, thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Harsh Doshi from Analysts India. Please go ahead.
Good morning, sir. I wanted to know whether the garment supply chain issue is 100% sorted now, and is that the reason for the healthy revenue in Q4?
Yes, that is one of the main reasons, because there were a lot of backlogs which had been created. So with orders in hand, we were not able to execute it, and now we've completely come out of it and have been able to establish different supply chains. Yes.
Understood. Also, I wanted to know what was the capacity utilization level in Q4 and the full financial year?
See, basically, it would be, flexible. So it goes by, different product categories. So maybe talking of leather gloves, it is almost 90%. Maybe garments, it is 20%. And for synthetic gloves, it is around 20%. And your safety shoes, it is again almost around 80% we are doing. But it is flexible, so it is not fixed like it is not a continuous processing plant. So we can work in one shift or two shifts depending upon some of the product category we can outsource also. So part of the manufacturing process can be outsourced also. But on the standard capacity, the way we are working, the range I explained, that is what we are doing. And it remains almost similar in all the quarters.
Understood. Okay, sir. Sir, last question. What would be a typical asset turn in our industry?
That is a bit difficult to, that because the industry itself is, so we hardly find our peers, and very hard, information is not publicly available, because you may compare us with some of the listed entities doing, safety shoes business. Very few are into garmenting, and gloves. I don't find much of the, listed entity. So it would be difficult to, compare.
Okay, sir. Thank you. No problem. Thank you.
Thank you. The next question is from the line of Lakshmi Narayan from Tunga Investment. Please go ahead.
Thank you. So, if I just look at the turnover, we have actually grown, but from an operating cash flow, we seem to be, underwhelming. So, just want to understand why our cash flows have been lower this year, and how does the company think about it?
Yes, so operating cash flow is on the lower side because of, increase of working capital requirements. So as you can see that, we have increase in inventory and debtors also. And this represents mostly, the target which this is at the end of the year, and we are targeting minimum growth of 15%. So the build-up is based, and the higher turnover we did for the last quarter also. So build-up, the entire base, this is the base, which is taking care of our future, turnover and growth requirement. So based on that, you see this decline in generation from operating activities. Yeah.
Is this, if I just look at the last several years, this seems to be lower in terms of operating cash flows. So when do you think this will get normalized? Is this like a one-off thing?
Please repeat. I'm not able to hear you clearly. Will you please repeat your question?
My question is that if I look at our operating cash flows over the last few years, I find that from that context also it's quite low in the last, if I look at from 2017 onwards, leave the 2022 year. So is this a one-off and we will actually go back to better operating cash flow levels, or this is something which would remain as we actually sign up for higher growth?
For that only, because we are investing and we are growing, so that way the whatever cash we are generating is being invested into either it is in capex or it is in working capital. So that's why this lower level of cash generation we see.
Right. So between the international business and the India business, how does the working capital change between India and international?
So working capital within India is it is on the very lower side, and so what we do in India, we hardly give credit to our distributors, so it is more of cash sale, and inventory also it is more rotating, and so definitely we need lower capital in case of Indian business. And in case of export business, it depends upon which market you are selling. So suppose it is far distance like American markets or South American markets, where it takes a lot of time to reach the goods. So customer would like to have better larger credit period. So it depends to which market you are selling, and definitely the working capital requirement is more in that case.
Got it. Any number you have in mind, sir? Because we have
it is in the range of for export business, it is net working capital days are almost 90 to 100 days. And in case of domestic market, it is around 30 days.
And secondly, when we actually export, do we invoice through agents, or do we actually have a sales office, or do we actually directly?
No, we invoice through agents only. We have in domestic market, we have around 85 distributors all over India, and we invoice through them only.
Exports markets, sir?
Export markets, again, it is mostly it is sold to distributors only. They are all reputed well brand like maybe Honeywell and Ansal and those type of brand, and they also are distributors only.
So then, in terms of the total capex you like to do for the next 3 years, so last year, in last couple of years, you have done at least in the range of 45 to 25 crores to 45 crores. Just want to understand how you think about capex for the next few years down.
So, as we have mentioned that for the current year, we plan to invest around more than 60 CR. So this is already planned, and this should be, taking care of our immediate investment plan. So nothing as of now, apart from regular investment which we keep doing in different product segment. No further infra creation we plan now.
Got it. Thank you, sir. I'll come back into you.
Thank you. The next question is from the line of Tushar Vasuja from Yogya Capital. Please go ahead.
Hello, sir. I hope I'm audible.
Yeah.
Okay, so my first question is on market size. So what's the market size for safety shoes, leather gloves, and garments, both domestic and international, global?
So this, we estimate for the global, I think around total market size is $50 to $60 billion. And it is a fair estimate that it is almost, 1/3 in hand protection, and then about 1/3 in above neck item, and maybe 1/3 in It's okay to estimate 25% across the categories, 4 categories that we are in. But there are also some items that we are not in, and that constitute a part of it. So usually these 4 categories will constitute a total of, let's say, 80 to 90% of the overall business, of the overall size. In India, we estimate something around 12 to 15,000 crores of the market, but largely dominated by feet protection and head protection in the Indian context.
Okay, sir. And one more thing I want to talk about is the 1,000 crore revenue that you guys are talking about. So what segment are you particularly looking the growth to come from?
So from multiple segments, we are expecting, from the feet protection, from actually all segments, we are expecting it to grow.
All segments equally, no segment in particularly high growth?
No such segment particularly in high growth. Like the segments where we are lesser present, we expect to grow in higher percentage in those. So for example, head protection or body protection, that's where we expect, and even the synthetic gloves, that's where we expect more, and footwear has to be lesser.
Okay, sir. And considering the nature of the industry, you guys might face a lot of competition from unorganized and local players. So can you talk a bit about that?
Yeah, we do almost, we say almost 50 to 60% of the Indian market is unorganized. So you can, understand the size of the unorganized market, and till the point the proper certifications in place in India, and there is, proper, policing of the standards and certification, this market will continue to grow. So that's the competition that we are in.
So Rohit, I would just like to mention here, that this the organized market, you will see, is growing, and it is also, happening because of market demand moving from unorganized to organized sector. So people are getting more aware of the quality product and who are the suppliers and product awareness and, the new products and quality products which we are able to sell. So the market is now getting aware of this, and so how it is happening, how the market is growing is because of, the newer users, new MNCs, the larger corporations looking for quality products. And they also in the past used to source from unorganized market only. So this market is shifting now from unorganized to organized, and that is the scope for the company, where we see that apart from launching your own promoting like safety shoes and hand safety and other segment of the product, which the market is one by one trying to pick up, the market should also move from. This is what we are witnessing.
Okay, sir, that's wonderful. I had one more question regarding the pricing of your industry. So, what's the pricing scenario like? Like, what things can affect your margins?
So that is not, so how we operate is that in private label segment also and in branded also, it is always cost plus our margin which we would like to keep. So whatever, price movement is, whether it is in case of currency or in case of raw material cost, so we are always hedged. So we take care of our margins, and we are able to negotiate with our customers at all times. So, so whatever business we are doing, we are protected, the margins are protected, and it doesn't matter much in most of the cases that the movement in the, prices of raw material or currency impacts our margins. That is not the case.
Okay, so what are the raw materials, like major raw materials for you?
So for for three segments like we manufacture leather and leather gloves and safety shoes. For that we use leather. Then we use PU for sole. We use nitrile compound for synthetic gloves. PU also for synthetic gloves. Then garments. It's fabric, both cotton and polycotton and synthetic. So these are a few of the raw materials we use.
Thank you, sir. That answers all of my questions. Thank you.
Thank you. The next question is from the line of Rahil Shah from Crown Capital. Please go ahead.
Hello. Good morning. Can you hear me?
Yeah. Good morning.
Yes. Hi. So you had mentioned earlier in one of the last calls that the North American market will be doing well from the next year onwards. So compared to the Europe market and Middle East as well, how important is it for us, the North American market, and how has it been so far in the Q1?
It is actually gone as expected. So it is performing, pretty well. We have some orders going in, some inquiries which are going strong, and some new developments also. So that market definitely we are witnessing a lot of positive development, and in the years to come that should become a big market for us. So that is in plan as per plan.
Okay. And I'm sorry to repeat this, but I had some interference earlier when you were mentioning the growth trajectory. So have I heard you correctly when you said 15% growth this year in FY25 with a 50 basis point margin increase you can expect, and from there on towards your target of 1,000 crores, you will grow minimum 25 to 30%. Is that how you're planning?
Yeah, for this year we are expecting 15% growth, and margins we don't expect to change much. We are working towards it, but we don't expect as of right now for a change in margins. And then yes, the 1,000 CR goal is also set. So whatever growth percentage we have to ensure that target is achieved, we'll try to work for it.
Thank you so much. All the best.
Thank you. The next question is from the line of Saket Mehrotra from Tusk Investments. Please go ahead. Hello, Saket. Your line has been unmuted. Please go ahead with your question. Mr. Saket, your line has been unmuted. Please go ahead with your question.
Yeah. Can you hear me?
Yes, sir.
Yeah. So my question is, how is Q1 looking for us, and what's the trajectory that we're expecting from our exports going forward this year and the year ahead?
So Q1 is looking much brighter as compared to last year, and also as compared to last quarter for us. This is on account of Shyamji was also mentioning, we have a lot of inventories and raw material now in stock which we can convert and convert into sale, and also some of the pending orders from last year because of supply chain which we were not able to do it. So that delayed is going out now, and a decent start to the domestic market also. Going ahead, the export market is seeing bullish as compared to previous years because Europe at least little by little is coming back, and North America has been like I said more responsive, and also the South American market has been decently responsive. So we are expecting a better Q1 as compared to last year or last quarter.
Okay. Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah. Can you hear me?
Yes.
Yeah. Just drawing on this 1,000 crores by 28, you would obviously have to go at 25% CAGR for next 4 years, and that will mean a 30% CAGR in India. That in an industry which is growing at 12, 13, 14%, that means you are essentially doing something which is different than what you have been doing. My question is, one answer could be merger and acquisition, and the question would be, what exactly would you look in a merger and acquisition? Which gaps should you fill in terms of product, in terms of geography of markets, segments, or geography within India that you are going to look at? Specifically, you have been very strong in maybe automobile and cement and construction and heavy industries. Are you looking at a separate industry altogether, like biotech or chemicals or IT, very seriously?
So in terms of the first question for M&A, so we are always on the lookout for interesting offers that there are. We would definitely like to strengthen ourselves in those product categories where we are not present, or in those geographies where we are not present, and if something like that comes up which complements our current offering, we would be definitely interested to look into it. So that's one. Second is with regards to the industries and geographies within India. So in terms of geography, we are there mostly where most of the core sectors are present. Core industrial sectors are present, which is mostly in the west and the south of the country. And in terms of some of the newer industries or different industries to look into, so something like construction is where we haven't been present, as compared to the size of the industry. Second is mining. That's something that we are also looking at getting into. So these are, I think, two main industries that we'll try to explore more and see, how we can improve our offering for these industries, because these are growing and, we are a very small player in those industries.
Okay, thank you very much.
Thank you. A reminder to all the participants, you may press star and one to ask a question. As there are no further questions, I now hand the conference over to management for closing comments.
Thank you. Thank you all for participating in this earnings conference call. I hope we were able to answer your questions satisfactorily and at the same time offer insights into our business. If you have any further questions or would like to know more about the company, please reach out to our investor relations managers at Valorum Advisors. Thank you. Stay safe and stay healthy.
Thank you. On behalf of Mallcom India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.